Negative interest rates are suppressing yields around the world where economic growth has been sluggish. Japan was the first country to enter those conditions a long time ago. Our next guest says this is becoming harder to avoid. Joining us now is Aon Chief Economist Tapan Datta, and it's good to have you here. When we talk about negative interest rates, I mean, we are still positive. The president wouldn't mind having them. He said as much. Do you think the United States could ever get to a point where we would see negative interest rates here?
Look, I wouldn't rule it out. It's still unlikely. I'll grant that, but I think, as Bernanke himself said a few weeks ago, it's not something that you can rule out, because in extreme circumstances, in a very deep recession, for instance, where nothing else is working, a period of negative interest rates is not inconceivable at all, even in the U.S.
Tapan, we have been watching the dollar-yen cross very closely as we see some significant moves over the last few days. We heard from the Bank of Japan Governor Kuroda overnight, who essentially said that there are grave concerns about the coronavirus as they go into the G20 meeting this weekend over in Riyadh. Do you get the sense that maybe some of the central bankers will get together to come up with some kind of coordinated effort, or are we not at that point yet?
We may well get to that point where some sort of coordinated effort does come forth. But the issue is that, it's interesting you bring Japan up, because Japan brings up the most extreme example of kind of monetary policy failure, where rates have gone negative. Fiscal policy has been on full throttle with rising public debt, and yet nothing has worked. So if the Fed in the US was having a nightmare, it would be along Japanese lines to say, look, we can get to a situation where nothing else will work. And we need to avoid that at all costs. And the debate is, what do we do now to avoid that?
Hey, Tapan, Pras here. We've been hearing a lot of talk about how the supply chain disruption is not just something that's going to affect, product for 2 weeks or a month, that it could actually affect kind of how we consume and get stuff for the next 6 months or something like that. Companies like Jaguar are having to fly in parts from China because they just can't get it. What's your take on
Absolutely. That? Oh, that was just a classic example of how integrated China is into global production chains, and it's totally different from the situation with SARS. I mean, China's integration with the global economy is huge, and this is a very good example of why this particular wave of concern over the corona is unlikely, I think, to go away particularly soon. I mean, if it was playing out with SARS, by this time we would be kind of really over the hill and saying, well, we can look. I suppose you could argue the markets were at this stage a week or two ago, and now doubts are setting in, because it ain't like that. China isn't where we were in 2003, and it's not something that you can argue can replicate what we saw all those years ago. It's just not like that.
So I am curious, when we talk about coronavirus, hopefully eventually will be in the rearview mirror. But mature economies, advanced economies, the Japanification of what we've witnessed with interest rates, when you've had such a long-term low interest rate environment as we've seen in the United States, or negative as we've seen in Japan, how do you grow interest rates? Are we locked in for the next 10, 20 years to these low interest rates?
Well, look, if you look at where the bond market is pricing future interest rates, it very much is arguing the Japanification story. There's no getting around that, because the market is basically saying the Fed is unlikely to be raising rates, much north of 1 to 1.5%. So, yeah, it may not be Japanese style kind of near zero interest rates, but the market has already moved a long way towards effectively validating that Japanification scenario. Look, I hope they're wrong in this, but frankly, the longer we hang around at these levels and the longer this bond market rally continues, the bigger the risk that it is just that much harder to get out of it.
But I mean, is it fair to make that direct comparison? I mean, if you look at an economy like Japan, demographics have played a big part. That's been a significant reason why they haven't been able to grow in the way they have been. I mean, is it time for, you think, maybe some central banks like the Bank of Japan to reconsider that inflation target, which is something that Kuroda's talked about before, that it doesn't have to be at 2%? Is 1% something that's more realistic?
Well, I think you're quite right that Japan could be aiming for a lower inflation target. But the fact is that the Fed has tried for a very long time to meet its inflation target and has failed, big time. So it's not surprising that Larry Brainard today is voicing a way of thinking about how we can get inflation up. because the Fed is not meeting its inflation target. Europe is, very close to deflation, has been kind of in and out battling deflation trends for a long time. So Japan, again, is more of an extreme, but the direction of travel across all the major economies is disturbingly similar. And that's the concern around global Japanification.
Aon Chief Economist Tapan Datta, thank you very much for being here.
Very welcome.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.